mutual owing. In question number 7, we incorporate the mutual owings. H Limited acquired 30 shares for rupees 500 in S Limited on 1/10/21. S Limited had 100 rupees in reserves as on 1/4/21. Investment of H Limited includes investment in debentures of rupees 100 at book value in S Limited. The creditors of H Limited includes 50 payable to S Limited. So the fourth adjustment is all about mutual owings. Creditors of H Limited includes 50 payable to S means for S it may be the debtors. For S it is debtors and for H it may be the creditors. So from here I have to subtract 50. Here I have to subtract 50. Okay, on merging 500 plus 100, the mutual owings of 50 will be subtracted from the creditors as well as debtors parallelly. And H acquired 30 shares. How many shares are there? 400 rupees, 10 each means 40 shares. 30 shares are there. Then holding percentage being or holding status being H company holds 30 out of 40 shares, 75%. Balance will be held by minorities, called as minority interest. So this one is also completed. S Limited had 100 rupees in reserves on 1/4/21. Very important thing is 1/4/21 they have reserves rupees 100 and the acquisition date is 1/10/21. So we are not aware about what is the reserves they have as on the date of acquisition. So then whatever the reserves they have, any reserves after this 100 could be considered as earned in the year 21-22. Okay, that may be based on the time basis you can segregate. So let's see here. Reserves and surplus. Reserves and surplus. 200 rupees. Reserves and surplus 200 rupees. Out of that, up to 31st March 2021. How much is that? 100. For the year 21-22, remaining 100 may be earned. The 200 rupees reserves and surplus can be categorized to the extent of reserves available on 31 March and thereafter 21-22. So as on 1/4/21, otherwise 31st March 21, the reserves being 100, but total reserve 200 means 100 exists as on the date. Thereafter, another 100 increases only due to the profit and loss in year 21-22. Now you have to segregate that into pre-acquisition as well as post-acquisition. Pre-acquisition profit will be called as capital profit. Post-acquisition profit will be called as revenue profit. Is that okay? This pre-acquisition, this 100 rupees already exists on 31/3/2021. The date of acquisition in this case being 1/10/21, right? 1/10/21. Clear? This one. So definitely this amount is earned before the acquisition, no post-acquisition profit. This 100 is earned from 1st January to 31st March. Okay, 1st January 2021 to 31st March 2022. For this period, the earning is 100 rupees, the acquisition date being 1/10/21. From here to here, 6 months we have, from here to here, 6 months we have. For the whole year, they earned 100 rupees means for the first 6 months, maybe 50 rupees. For the second 6 months, it may be 50 rupees. We assume the income generated evenly throughout the year. There is no any weightage in any of the months. So in case some governments and all, no, during the festive season, the sales may be double than the usual sales in a month. Then you have to make some adjustments. Usually in this case, we never bother about the other thing. There will not be any fluctuation in this profit in any of the months. We assume that 100 rupees is earned throughout the year evenly. So for the first 50, say up to the date of acquisition, the profit may be assumed to be 50. Thereafter, it is another 50 rupees. Is that clear? Hope now we'll be able to understand this one. With that, this 200 rupees is taken. Investment of H Limited includes investment in debentures 100 at book value. The 30 shares purchased for 500 rupees. Here see, investment 600 rupees. Out of that, for purchasing the equity share capital being 500, for debenture of S Limited being 100. Is that okay? Debenture 100. So H Limited invested by purchasing the debenture of H Limited. So it's an investment. For S Limited, they have issued the debenture for H Limited. Now, if we are merging, this is also mutual cancellation. Like this 100 will be cancelled along with the debentures liabilities in S Limited. So for S Limited, as they have issued and raised the fund, it is a liability for them. For H Limited, they have purchased this debenture from S Limited by paying 100 rupees at the face value. So while merging, the liability as well as the investment both will be getting cancelled. So here this 100 and 100 is cancelled. Only 500 left with. Is that clear? And this one was already adjusted. Now come on, find out the cost of control as well as minority interest. So 150 is the pre-acquisition profit or capital profit, 50 being the post-acquisition profit, can be segregated to holding company as well as minority interest. Minority interest. Similarly here, minority interest as well as holding company. 75%. Come on, 75% on 150. 112.5, and this will be 37.5. So for minority interest, the value being 50 rupees. This will be the capital profit. This will be the revenue profit. Now I'm going to prepare the cost of control as well as minority interest. Now cost of acquisition. Cost of acquisition in this case being 500 rupees. 500 rupees. Already 100 rupees was taken. Now another 500 rupees also taken. So with that 600 is totally cancelled. And minus what? Net worth. In net worth, equity share capital face value will be taken. The equity share capital being 400 rupees for all the shares put together, where H company holds 75%, which is 300 rupees. Another 100 rupees shares held by minority interest. So equity share capital 300. And the capital profit will be part of net assets, net worth. So I am adding this 112.5 with this, and profit for minority interest being 50 rupees. This 37.5 will be addable with reserves and surplus, 37.5. Is that clear? So I have put the tick mark for all the three. So the total net worth being 412.5, but the payment is 500 rupees excess by 87.5. Am I right? So as you pay more, then it is called loss or goodwill here. So 350 will be the minority interest. Now I am going to incorporate that. So equity share capital being 1000 rupees, and reserves and surplus being 600 plus 37.5, 637.5. And then minority interest, I have to introduce newly this value 350. Which one? Yeah, okay. This is 150, 150, right? So this is 100 and this is 150, 150 minority interest. And then goodwill will be part of intangible assets along with non-current assets. Goodwill, this value being 87.5, 87.5, and non-current liabilities being 400 rupees. That 100 rupees got already cancelled. Mutual owings, right? 500 plus 100, 600 minus 50, 550 will be the current liabilities. Here, investment, the tangible assets 1500 plus 500, 2000 rupees. Investment got totally cancelled. Current assets being 400 plus 300 minus 50, 650. Come on, get me the total value here. What's the total value? 2737, right? 2737.5. 2737.5. Clear? If it is clear, text me. We will move on to the next one. Shall I move on to the next one? Text me. I got the message only from Sivaram. What about the others? Now, next one. So, in this illustration, we have mutual owings as well as unrealized profit on unsold stock. In case of unrealized profit on unsold stock, actual transfer being downstream. Okay, the sale may be downstream or upstream. If the goods are moved from holding to subsidiary company, then it is called downstream. In a reverse case, it's upstream. In case of downstream, that unrealized profit will be adjusted only in the books of holding company. In case of upstream, right, it will be adjusted in both. Holding company share will be adjusted in their own profit and loss, and minority interest share will be adjusted in minority interest value. That's all. So rest of the things will be the same. Already we have studied in amalgamation. Now you can apply the same logics here. So already told you, for calculation of CFS, Consolidated Financial Statement, 5 steps are involving predominantly. You have to understand how to handle in case of mutual owings related to the debtors and creditors, BR and BP, debenture and investments. For in the last illustration, for the subsidiary company, it is a debenture issue. For the holding company, the same will be investments. So both may be cancelled. Not necessarily same value. In the books of subsidiary company, the value may be 110 liability side. Okay, holding company and subsidiary company debentures. In case of assets, no investment, it appears in the holding company as 100. That was an earlier illustration. Rather than 100, if the value appears at 110, what happens? Okay, sorry, 100, 110, sorry, 100, 110. Earlier, 100, 100. For subsidiary company, the debenture value being 100. For holding company, it's investment rupees 100. But rather than equal amount, if the subsidiary company shows the debenture value being 100 and subsidiary in holding company, it is shown as an investment, but not the same value, maybe 110 or 90. How can we do now? Then also you can cancel that excess amount 10 rupees is no named as goodwill. Otherwise, original liability for subsidiary company being 100, but we paid 110. So we paid 10 rupees excess. That excess payment will be considered as goodwill. In the reverse case, if you pay lesser, then it is a capital reserve. This will also may happen. Why, sir? The debentures may be traded in the secondary market. Holding company could have purchased the debentures in the secondary market by paying excess or lesser. Who knows that? So we are not sure. So not necessarily both the value may be same. Sometimes it may be mismatching. The difference will be called as goodwill or capital reserve. And now we have to incorporate the unrealized profit on unsold stock. Not only unsold stock, sometimes unused assets also may exist. Right. Holding company transfers 1000 rupees worth stock, stating 1200 to subsidiary company by including 200 rupees profit. If that stock remains unsold in the subsidiary's book, so after the merger, the same stock becomes a stocks of holding company, then they know what's the real value, so they have to remove that 200 rupees to incorporate at its own original cost. Not necessarily it's for only asset, stock. Sometimes the assets may also be. Holding company may transfer some of their own assets. Their book value may be 1 lakh, transferred at 1,20,000 rupees. That asset remains in the balance sheets of subsidiary company. While amalgamating, the balance sheet subsidiary means the subsidiary company's balance sheet assets will be clubbed here. So that case also you have to eliminate this one. You understand? Holding company as well as subsidiary company. Right. Now what happens? In the liability side, in the asset side. Holding company and subsidiary company. Holding company transfer 1 lakh rupees worth asset by including 20,000 rupees profit as 1 lakh 20. While transferring, holding company recognizes 20,000 rupees as profit on transfer, and this will be shown in subsidiary company as asset 1 lakh 20. 1 lakh 20 asset. While consolidating, consolidated financial report or statement. So this is nothing but the assets and liabilities of holding and subsidiary both will be clubbed. This 120 will be clubbed in this case, but he knows that here is unrealized profit 20 should be eliminated. Now it is 1 lakh 20, 1 lakh. That same 20 is deducted from the profit as is not being realized, so the profit here after being 0. Independently, H company shows 20,000 rupees profit and subsidiary company records the value of the assets at its own purchase price, which is 1 lakh 20,000 by adding the profit of holding company. While clubbing and showing as a single balance sheet, holding company notes the real value of this 1 lakh 20,000 rupees worth assets. So he knows that it's only 1 lakh. So he shows that at 1 lakh by reducing the 20,000 rupees, and to the extent of value reduced, no, will be now adjusted in the profit account, profit and loss account. Is that clear? So what is that? Unused assets are unused assets. Probably this is how transferred in the year 1, matter of 5 years later. Okay, matter of 5 years later, this asset was depreciated over 5 years period. Now the asset is only 60,000 rupees. 50% already depreciated. It means 50% of the life of the asset was used. Still, the asset has another few more years to enjoy. For the few more years, the value is only 60. He knows that for every 100 rupees, 20 rupees profit is added 120. Today, the value of the assets in the books of subsidiary books being 60. Right. It includes how much profit added by the holding company to subsidiary company and transfer. You do the same application, so 10 rupees and 50 rupees may be the cost. 50,000 rupees worth this asset transferred for 60 by inputting 10,000 rupees profit. Now, while preparing the consolidation in this case, okay, what happens here? This is not 60,000 worth, it is only 50,000 worth. The profit, no, you have to subtract only to the extent of unrealized profit. The unrealized profit on the unsold stock asset being only 10, not 20. So you are now reducing the 10 rupees, now 10,000 rupees, now the new profit being 10,000 rupees. Is that clear? So similarly, any stocks transferred from holding to subsidiary company by adding the profit, it remains unsold. Only then the unrealized profit will be reversed. If the stock moves out of the subsidiary company, no need to do any adjustment. So the statement itself very clear, unrealized profit on unsold stock. In case of asset, unused asset. Is that clear? So in this case, we have been given downstream as well as upstream. If the original transfer happens between H and S, where the transfer is made by H. In case of upstream, the value will be value of the stock transfer from subsidiary company to holding company. Is that okay? Holding company to subsidiary company, while adjusting unrealized profit, it will be adjusted only in the books of H. In this case, the unrealized profit will be adjusted in the books of holding company as well as minority interest as per their own proportion. Probably 80% being the holding company's status of holding. Then 80% will be for holding company's P&L account to be adjusted, and 20% will be adjusted in the minority interest, right? Minority interest. So we have completed the fourth one also, mutual holdings. And we have completed revaluation of assets. Liabilities will have no much difficulties, are very easy. If the liability is increasing, additional capital loss. If liability is decreasing, additional capital loss. Capital gain. Liability decreasing means gain. Of course, there is no any depreciation. It's very straightforward and easy. But in the case of assets, if we have the depreciation, the calculation is pretty different, right? So we have seen that case in the previous illustration. So we learned these 5 steps, first of all, and we learned these 3 adjustments also. We left with only 2 more adjustments to be incorporated. So now before go for the 1 and 2, let me try to finish up this unsold stock profit, right? So in this illustration, I'm going to guide that one. Yeah. Downstream. Yeah. So prepare consolidated financial statement from the balance sheet. And H Limited acquired 90% shares in this Limited when S Limited had 115 reserves. So percentage of holding being 90 percentage and 10 percentage. Second step, resource and surplus. Resource and surplus. Total resource and surplus being 200. Pre-acquisition reserve being 150. Post-acquisition reserve being 50. Post-acquisition reserve being 50 rupees. H Limited sold goods costing 40 for 50 to S Limited, and the amount was unpaid as the year end. So H Limited sold goods to S Limited. The real cost being 40 and 10 rupees profit added. So from this it is very clear in the books of H, S being debtor, S being debtors for rupees 50. In the books of S, H being creditors rupees 50. This is all about mutual owings, and you can cancel the debtors and creditors. Apart from that, the stock what now S Limited received from H Limited, out of that 50% sold. 50% sold. If it is sold, no problem. Anything remains unsold. Then in case of unsold, the unrealized profit on unsold being 5 rupees. Am I right? So 10 rupees is the overall profit. Out of that 50% sold. Means 20 rupees plus 5 sold. 20 rupees plus 5 remains unsold. The profit on the unsold stock will be now identified. We identified. Next, verify whether it is a downstream or upstream. This is downstream. Okay. In case of downstream, this entire loss will be adjusted in which book? Only in holding company's profit and loss account. Is that clear? Now, debtors and creditors. Here, I am going to subtract 50 rupees from here. Here, 50 rupees. For H Limited, S Limited being the debtor, so debtors is eliminated. For S, it is a creditor, so creditors also eliminated. Apart from that, we have been given what? Unrealized profit being 5 rupees. Okay. Unrealized profit. Unrealized profit on unsold stock. The value being rupees 5. The value being 5 rupees. Will be adjusted only in the holding company's books. This 150 capital profit will be shared between holding and minority interest. This 50 also be shared between minority and holding. For holding 90 percentage, 135. For minority interest, 15 rupees. In this 50, 10 percentage, 5 rupees for minority interest, 90 percentage, 45 for holding company. 3 items are recognized. Now, finally, I am going to calculate cost of control as well as minority interest. Cost of control and minority interest. What is the cost of acquisition? Investment, which is nothing but the shares in S Limited. So, all the 600 is for that purpose only, for this investment purpose only. Minus net assets, where equity share capital face value will be taken. 900 rupees is the face value of the equity share capital of S. Out of that, 90% held by whom? H. So 90% being 360, and the equity share capital held by outsiders, minority being only 40. Only 40. Is that clear? Now, apart from that, this is capital profit 135. This is minority interest share 20. This will be 5 profit. This will be a deductible item 5. So the ultimate value being 40 is going to be addable with the resource and surplus. This will also be transferable and adjusted in the resource and surplus. The unrealized profit should also be adjustable only in the resource and surplus. This is 45 appreciation of the profit. This 5 rupees is decreasing the value of the profit. Ultimately, you can add 40 rupees. 45 plus minus 5 rupees. Now, 495 is the net worth. Payment is 600 rupees. You paid 105 excess called goodwill, and minority interest being 60. Equity share capital being 1000. Resource and surplus being 60 plus 40, 640. And minority interest here being 60. And non-current liabilities 400. Current liabilities 500 plus 200 minus 50, 650. Non-current assets, intangible assets, goodwill 105. Tangible assets 2000. And investment got eliminated. Current assets 400 plus 300, 700 minus 50, 650. Yeah, find out the total value here. $2,750. 2,750. Here stock value should also be subtracted. It should be posted twice. No, I missed it. Minus 5. So this is 645. 645. Make a note of it. 2,750. Double entry should be adjusted in holding company as well as in stock. Should reduce the stock as well as profit of the holding company both. Is that okay? Stock value also be reduced, profit also be reduced. Clear? Yeah, make a note of it. Clear? Shall I move on to the next one? Upstream case. Make it faster. Now, question number 9. Mutual owings and unrealized profit on unsold stock. Upstream scenario. Upstream scenario. So rest of the things are same, I think. Acquired 90% shares, 150 reserves. Everything is similar to the earlier one. And 40-50. 40-50. Okay. So status, holding status, 90% and 10%. Resource and surplus 200, pre 150, post 50. post 50, holding and minority interest, 135 for holding, 15 for minority, 45 for holding and 5 rupees for minority. Overall profit for minority being 20. This will be the capital profit meant for the holding company. This is revenue profit meant for the holding company. Let me incorporate the second point here. It's pretty simple. What's that? Goods costing 40, sold as 50 to H Limited. Okay. The amount was unpaid on the year end. If the amount is unpaid, then the entire 50 remains unpaid. Will be now debtors for S Limited should be eliminated and creditors for H Limited should also be eliminated for that value. This is mutual owing. Usually the mutual owings and unrealized profit both will come as a combined entry. Okay. But not necessary, may come. And out of that, 50% of such stock remains unsold. H Limited only sold 50%, remaining another 50% remains unsold. What about the scenario? Is it upstream or downstream? S to H, the movement happens from S to H, then it is called upstream. Upstream. Then what about the unrealized profit on unsold stock? 5 rupees. Actually 10 rupees, 50% sold, remaining 50% unsold. For the unsold item, it is only 5 rupees. This 5 rupees, first you have to subtract from stock 5 rupees. Another one is it should be subtracted from profit 5 rupees. But whose profit? As it is being the upstream, 90% will be adjusted in H Limited's profit. Out of 5, 90% being 4 rupees 50 paise will be adjusted in H Limited. And for S Limited, minority interest, you have to adjust 0.5. 0.5. Is that clear? Clear? So in case of downstream, you are aware about that the profit is added by holding only. So it is adjusted there only. In case of upstream, right? Holding says, you have realized you profit and distributed for me as well as for minority interest both. The profit is now shared by whom? Holding as well as minority interest, because the profit is now realized in the hands of the subsidiary. The profit realized in the hands of subsidiary is for both the party. So while reversing, both the parties' profit will be adjusted. That's the logic behind upstream and downstream. While holding company adds the profit, this is only for the holding company, so they will adjust that completely in their own profit and loss. Clear? You have to understand the logic of downstream and upstream and adjustment of profit. Right. Let's now go for calculation of cost of control as well as minority interest. Cost of acquisition. The shares acquired at rupees 600 and net worth, equity share capital face value 400, out of which 90% here 360, here equity share capital 40, capital profit 135, profit for the minority interest, accumulated profit. You don't say capital or revenue profit for minority interest purpose. And this 45 will be now adjusted here. Okay. I'll put the value here 600, add 45, and what about this 5 rupees will be subtracted from the stock, what about this 4.5 should be subtracted from the holding company's profit share. What about this 0.5? It should be subtracted from the minority interest profit share and realized profit. So 59.5. What about this value? 640.5. Am I right? And net worth being 495. 105 will be the ultimate value. 105 will be the ultimate value. So you pay more, so it is goodwill. So equity share capital being 1000. This one was already taken. Instead of that, we get 640.5 and minority interest 59.5, debentures 400, 500 plus 200, 700 minus 50, 650. Right, goodwill 105 and tangible assets being 2000. Investment got eliminated. In case of current assets, 700 minus 55, 645. Come on, find out the total here. I think it is 2750. 2750. So we now left with the two more adjustments to be incorporated. One is dividend, another one is bonus share. In case of advanced problem, you will always face the dividend as well as bonus share. Always you face dividend and bonus shares. Let's move on to the next one. So I have broken the illustration into small illustrations like to make you understand all the concepts. Okay. If you are able to understand each and every concept perfectly, then the entire chapter will be easy. Any number of illustrations you can solve. Right. Now let's see. We'll be now dealing with the dividend. Right. Let me first explain the concept of dividend here. Okay. H Limited, S Limited. H Limited purchases the share from it, somebody else, share of S from somebody else. Okay. So the date of purchase being 1/4/2025. Date of purchase. Cost of purchase being 100. Cost of purchase being 100. Face value of the share being 10 rupees. Okay. And dividend declared. Dividend declared. Okay. Dividend declared. So H company received the dividend from S company on 5th April 2025. Rupees 15 and probably 1st August 2025 rupees 5. This is final dividend. This is final dividend. This one is interim dividend. Interim dividend. Clear? Final dividend and interim dividend. This 15 rupees is related for the year 24-25 whole year. Interim dividend is related for 1/4/25 to 36/25. For the 3 months result to know, for that they have announced 5 rupees. Come on, pass the journal entry for this. What is the journal entry for this? On receipt of the dividend, you have to pass the entry in the books of H. What is the journal entry? Bank account debit to dividend. Dividend will be ultimately transferable where? Where will you transfer? Usually transfer to P&L account. That is error of principle. Okay, that's a error of principle. It's not the correct one. Clear? Then what is the correct one? Let me go for this one. For this, the entry being bank account debit to dividend. Ultimately, the dividend is transferable to P&L account. P&L account, dividend account debit to P&L account. 5 rupees. This one is correct, but this one is not correct. Why? Whatever it may be. So what? If the face value is 10, if you are getting 15 rupees, don't you feel happy? Sir, give me dividends, sir, not 15, 150 also. What's there then? Then come and tell me what's the error here? What's the error? Any guess? Come on, make it faster. The very first class itself, I started with the same. What's that? Capital profit. This is not revenue profit. This is a capital profit. Because you purchased on this date, immediately you get this 15 related to the profit earned before the purchase date. So you purchase on 1/4/25. The seller says, sir, company already announced the dividend, accumulated huge profit. In a matter of 2 or 3 days, you will get 15 rupees profit. Stating that he demands more purchase price. So I will not sell for this rate, sir, because you will be anyhow get 15 rupees. So then the entry you might have passed on 1/4/2025 for purchase of the share being investment account debit, shares, equity share capital of, yes, that's what about the investment to bank. The amount actually paid for purchasing this being 100, you are pretty sure that this 100 includes immediate dividend you're supposed to get in a matter of a week's period. Because of that reason only you paid more. As you expected on 5/4/2025, you are getting the dividend. If you are getting the dividend, then the entry being bank account debit to what? Investment. It's reversal of investment. Value being 15. Hereafter, the investment value is only 85 rupees. Is that okay? The cost of acquisition is not 100. Hereafter, it's only 85. If the cost of acquisition decreases, what does it mean? You are paying lesser for the net worth. If you are paying lesser, in case of goodwill, it will be reducing. In case of capital, it's increasing, right? So otherwise, if you are not properly valuing the investment's worth, then the capital or goodwill gets affected. The cost of control gets affected. You have to be very careful. Very careful. This one is correct because you purchased thereafter another 3 months. The business worked and earned the money. From that money, they have given 5 rupees. That's your profit naturally. So in the previous class, I told you this one is called return of investment. What you invested, no, you are getting it back. It's called return of investment. This one is called return on investment. Your investment worked and generated revenue, that revenue is given. That's called, it is return on investment. You have to understand the difference between return of investment as well as return on investment. So what happens? Usually you will make the mistake. If it is properties done, no problem. Usually there will be mistake. Then it's now your duty to rectify this. You are pretty sure that this one is wrong. This one is wrong. How can I rectify this one? Actually, investment should be credited, but they have credited wrongly to the dividend. So I have to debit the dividend. Otherwise, P&L account should be debited. And you have to credit only investment, so I am crediting that investment now. The value being 1515. This is the rectification entry you have to pass for what? If the dividend distributed out of pre-acquisition profit. If the dividend is distributed after the post-acquisition profit, naturally that will be transferable directly to your P&L account. There is no any harm. That's correct because it's a return on investment. But there is accumulated profit before you acquire, and from there, if any dividend is given, that dividend should be subtracted from the investment rather than subtracting from the investment. It is credited to the P&L account. It's an error. So naturally, you have to go for rectifying that error by crediting the investment and debiting to the P&L account. So you have to remove the wrong credit in the P&L account and add to the means adjust in the investment account also. Clear? Hope you'll be now able to understand. Any doubts? So dividend given out of pre-acquisition profit, but they have wrongly credited in P&L account. That error will always come. Now it's your duty to rectify this error by passing this way. So in the very beginning page itself, I have given that one here. Okay. Adjustment number 1. Dividend out of pre-acquisition as well as post-acquisition. If the dividend is distributed out of pre-acquisition dividend profit and properly credited investment, no need to do any adjustments. Rather than that, if it is credited wrongly in P&L account, now it's your duty to reverse that. So P&L account is going to be debited, investment is credited. That will be the work. In case of post-acquisition profit, there will not be usually any error. Normally, we will transfer to the P&L account. What you are doing is correct, so you no need to do any adjustments. See here. Receipts of dividend from subsidiary out of pre-acquisition profit should be debited to the bank and credited to the investment in subsidiary company is the correct entry. Note, when interest in subsidiary companies acquired in block, okay, this will be not at your level, so we'll see that later on. So hope you will be now able to understand the correct journal entry here. If such entry is not passed, it's your duty to rectify. Clear? Yes. Come on, make note of it. So we'll go solving the illustrations along with the incorporation of dividend here. Make it faster. Shall I move on to the next one? Come on, text me so that we'll solve the illustration, including this adjustment. Now, question number 10. Copy. Okay. Question number 10. Prepare consolidated financial statement from the following balance sheet. H Limited acquired 80% shares when S Limited had 100 rupees in reserves. So, holding status being 80% and 20%. Is that okay? Now, reserves and surplus. Reserves and surplus. Right. Estimated declared and paid 10% dividend out of pre-acquisition profit. And H Limited wrongly credited. They will not use the term wrongly, you have to guess it. So when the dividend is distributed out of the pre-acquisition dividend, it should be credited to the investment account. Instead of that, they have credited to the dividend received, and from there it transferred to the P&L account. Also wrong. Now it's your duty to rectify this one. This is very simple. And one more thing that you have to understand. What's that? That's very, very important. Let's see here. Okay. Usually this place also you have to be very careful. This place is very, you have to handle it carefully. What's that? Yeah, tell me. What's the dividend distribution? For 400 rupees, 10% being 40 is the pre-acquisition dividend. I write that here, pre-acquisition dividend. Pre-acquisition dividend. Okay. 40. In that 40, how much for holding company? 80%. 32. How much is for subsidiary minority interest? 20%. 8. For the minority interest, you don't have the classification as capital and revenue. Already we have studied. So it is not a matter for us. Only this will be the matter. This will be adjusted in where? Okay, it should be now subtracted from the profit and loss account and subtracted from the cost of acquisition of the shares. These two. You have to subtract from the profit as well as you have to subtract from the investment. Both. Okay, the journal entry being profit and loss account debit to investment. Okay, investment will also be reduced and profit also be reduced. Come on, tell me. The another main point to be noted here is H Limited acquired 80% shares in S Limited when S Limited had 100 rupees in reserves. 100 rupees in reserves. Yeah, come on, tell me. What about the total reserve they have? Total reserve they have? And how much is for pre? How much is for post? How much is for pre and how much is for post? That's the book. Okay. Now tell me, pre and post. How much is for pre? How much? 160. 100 rupees is the pre-acquisition profit. Pre-acquisition profit being 100. Out of that, dividend distributed, thereafter leftover pre-acquisition profit being 60. Balance pre-acquisition profit. Right. 60 will be the pre-acquisition. So you have to do the parallel adjustments. You have to do the parallel adjustments. Pre-acquisition profit 100 stating that or showing that the seller may demand buyer being the H Limited could have purchased. Keeping that 100 also in his mind. Sometimes later from the 100 he received the dividend. His share being 32 he received. Right. On receipt of that, it should be credited in the investment, but they have wrongly credited the P&L account. That will be separately adjusted. So hereafter, in the closing balance sheet, they have 200 means. In that 200, leftover pre-acquisition profit only being 60, balance 140 could be earned after the acquisition date. So it will have the connecting adjustments here and there, in both the places you have to adjust. Now, for holding company, for minority interest. For holding company. 48 for holding company and 12 for minority interest. In that 140, 28 is for minority interest, 112 for holding company. Clear? Clear? Now we can proceed solving or finding the cost of control as well as minority interest. This will be the most important aspects to be covered. Now, cost of control and minority interest. Cost of acquisition. How much is that? 600. Net worth. Equity share capital. 400. Out of 400, holding company status being 80%, 320. Minority interest status being 20%, 80 rupees. 20%, 80 rupees. And the capital profit 48. And profit for minority interest 40. Holding company's profit will be addable here. Add 112. Add 112. And should be adjusted for the wrong credit. So 32 subtracted. Should be subtracted from the cost of acquisition. Otherwise, pre-acquisition dividend. Pre-acquisition dividend. How much is that? 32. Either you can subtract from here or collectively you can subtract from here. It will have the same meaning, right? So I have put the tick mark for all these values. Now 400 will be the net worth, and we paid 600 rupees, 200 rupees excess payment is called goodwill. Minority interest being 120. After the adjustments, the profit balance being 680. 680. Show the equity share capital being 1000. Reserves and surplus, refer working note number 1, 680. And minority interest 120. Goodwill 200. Debentures 400. Current liabilities no adjustment 700. Current assets no adjustment 700. Tangible assets no adjustment 2000. Hope the value being 2900. Cross verify. Will you be able to get this answer or not? Come on. Hope you will be getting this value. Okay. Now, in the 11th question, dividend out of pre-acquisition profit but credited correctly in investment account requires no adjustment. But the confusion is to find out what could be the pre-acquisition profit. Okay. Estimated, declared and paid 10% dividend out of pre-acquisition profit, and H Limited credited the dividend received in its investment. This is prompt, no issues. For the face value of rupees 400, at the rate of 10%, 40 rupees may be the dividend payment. Right. This 40 rupees is out of pre-acquisition profit, you know. H Limited acquired 80% shares in S Limited when S Limited had 100 rupees in reserve. By the time it is 100, sometimes later, from that 140 rupees was already used for dividend distribution. So, pre-acquisition profit hereafter only 60. So, for that one adjustment only, we have to incorporate that. So, we no need to adjust in the profit or loss and all. Right. So, let's see. 80 and 20%. And reserves and surplus 200. Share for the pre as well as post. Pre being 60 and remaining being post 140. Share for holding and minority. Holding and minority. and 80 percentage 42, 20 percentage here, 28 here, and 112 here. You never bother with what? Unrelated means the dividend distribution. It will have no impact. How do you calculate this one? 100 minus dividend distributed. Okay. 860. That's how we calculated the pre-acquisition profit. Now cost of control as well as minority interest. Cost of acquisition being 600. This one also taken. Minus face value of the equity share capital held by holding company in S Limited. Out of 400, 80% 320. 320. For minority interest, equity share capital being 20% 80. Capital profit 42. 48. 48, okay. $48, 368, 368. Minority interest share of profit 40. This will be 112 added with this. Now 232 goodwill, 120 being minority interest, 1000 reserves and surplus 712, minority interest 120. This was already incorporated. Debentures 400, current liabilities 700. Goodwill 232, 2000 dash 700. 2932 is the total. Okay. Yes, come on. If it is clear, text me. We will move on the next one. Twelfth question. So dividend out of post acquisition profit. In case dividend distributed out of post acquisition profit, it will have no importance at all. You can forget this. Usually you don't get any illustration in this type because the proper. If you are getting and you will be crediting in P&L account, forget about that. That's all. Estimated acquired 80% shares and 10% dividend out of post acquisition profit and credited the dividend received in P&L account. So it has no importance. They have done clearly. No need to worry about this. So 80-40, 80-20, and reserves and surplus being 200. Segregate that to pre and post. Pre being 100. Pre being 100. That remains unaffected. Profit earned after this 100 rupees will be called post acquisition profit. From there only dividend is distribution. You don't need to adjust this. Then post acquisition profit after the distribution of post acquisition dividend, we still have 100 rupees. So holding and minority interest. 80, 20, and 80. This will be capital profit. This is the profit for the minority interest. This is the revenue profit for the holding company. Right, cost of control as well as minority interest. Cost of acquisition in this case being 300 minus equity share capital 400. Out of that 80%, 320, and equity share capital of minority interest being 80 rupees, capital profit being 80, and profit share for minority interest being 40. This 80 will be addable with the reserves and surplus here. 400 is the net worth, but we paid lesser, so this difference will be called as capital reserve, and this is 120 minority interest. Equity share capital being 1000. In reserves and surplus, reserve and surplus 680, capital reserve 100, overall the value being 780. Then minority interest 120. Okay, no change in debentures and current liabilities, and goodwill, no goodwill, right? So then this value being 2000 and this value being 1000. Hope that total being 3000. Usually you will not expect question this type, but anyhow a coherency order to be followed now, so I have incorporated this one here. The value being 3000, it gets tallied. Clear? Still two more illustrations are for the dividend, and 3 illustrations for the bonus sheets. With that, all the things are over. And question number 18, how can we consolidate P&L account? For that, one illustration. Other problems, question number 1 and 2 was given in CA book, so I have incorporated those illustrations also. I need 1 or 2 sessions to complete this fully. Okay, we'll continue.